Welcome to Stifel's Investment Strategy Brief, a monthly recap of the macroeconomic and market environment.
Well, greetings and welcome to the Investment Strategy Brief podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. So it's the latter part of November 2025, and in this episode, I want to get into the idea of some cracks in the markets, especially the equity markets. So I believe in our last episode, we got into this idea of expecting a bit of a pullback and how to get ready for that. And we've experienced some of that. So I want to sort of set the stage to help us understand what's been happening, why it happened. Maybe to begin, let's talk about geopolitics and politics. So we know in D.C. that there have been big changes in policy with big tariffs being imposed, and then a spending bill, then a shutdown, all against the backdrop of an effort to basically make the government more efficient. Of course, that involves some a little bit of spending cuts and workforce reductions, but also then less regulation, which is generally thought to be a tailwind to the markets. In any event, this is against the geopolitical environment where we know U.S.-China competition is as active as ever. We know that there's a focus on fiscal trajectory, which I'll talk about in a moment. And then when it comes to the military hotspots, still stuff going on that is unsettling. Russia, Ukraine, of course, recently in focus. So it's almost like the political and geopolitical environments at best are kind of mixed, but generally lean a little bit negative in terms of creating some uncertainty and some worries amongst folks. With that said, the economy has held up well, and that's including really an active consumer. So retail sales that bounces around a little bit has generally been positive. Confidence and sentiment are down a little bit, but think of it as the consumer remaining engaged. And, we look at things like the contributions to GDP. So when we look back over the longer term, let's say 10 years up to the pandemic, maybe consumption would be about 1.5% of the annual growth, contributing 1.5% roughly to the annual growth of GDP, and that was a little bit more elevated in 2023 and 2024, and 24 almost 2%. But in the first half of 25, anyway, that number has been about cut in half, and so there's been talk about a little bit of a slowdown. And when it comes to the consumer, it is a little bit related to demographic from a financial perspective, meaning that low-income people are struggling a little bit, cutting back a little bit, versus middle and high income are still, especially high income, still spending. Now, there's been lots and lots of talk about the labor market and cracks in the labor market. And while we had a little bit of a pause in data with the government shutdown, as the data starts to come back out, it's still showing decent numbers, meaning unemployment now sits as of a September mark at 4.4%, and we're seeing jobless claims, there, but not extreme. And then we did get an updated non-farm payroll report at 119,000, and a recent one. And that's a little bit below the 10-year average pre-pandemic. It's certainly below the reopening levels. So a little bit of softening, but not horrible in terms of the job market, right? Now, the Fed also then tends to look at inflation, as we know, and that's another area where we're waiting for the latest data. It'll be sort of a makeup, meaning that the survey didn't get done as the government was shut down, but we'll get a recent survey, and then we'll at least know from the beginning, the last data points before the shutdown till now, what that sort of delta is in inflation. So that'll be super helpful. But the punchline is the Fed's balancing all of this. Now, again, this is against the backdrop of what's probably a slightly slowing economy, call it in the fourth quarter, although there's certain data signaling possibly, even more resilience. But in any event, the Fed's basically looking at all this, so the economy holding up, jobs weakening a little bit, and inflation firm a little bit, but getting back towards the 2% target. All that to say that, essentially the market is really uncertain about a Fed cut at its December meeting, another quarter point cut. And so when it comes to cracks in the equity market, one of the things the market seems to be pretty sensitive to is whether the Fed's going to cut in December. It's a little bit short-term focused in my view. But anyway, the idea here is as we've watched the futures, that probability for a cut has sort of fallen below 50% and gone back up above 50%. And so the market's really bouncing around in terms of what investors are expecting at the December meeting. And this is informed for sure by basically public comments from the Fed. Different speeches are given, and then the market kind of reacts to that accordingly. So again, I think the spirit of this is to say right now, incrementally, the market is pricing in another quarter point cut, but we're definitely setting up for a potential disappointment when it comes to that. Now, turning to sort of another issue that I mentioned a moment ago that it remains in keen focus, the idea of the fiscal trajectory and the need to go through a fiscal transition. Rates remain high, debt remains high, and continues to grow, especially in the U.S. government. And I've started thinking about it as a bipartisan problem. So the debates that the Democrats and Republicans get into are really incremental on, should we spend $1.8 trillion in terms of excess for a deficit or $2.1 trillion. It doesn't really matter in a way, that delta, in the sense that both are kind of problematic in terms of building debt over the medium to long term. And so all that to say then that we believe that there's a need to get for this to come into focus. We've talked about that for a long time. And what's been interesting as we've studied this is to understand a lot of different papers and sort of thoughts out there around how to think about this and methods to kind of get there. And so think of it as in terms of wanting to get the deficit to a level of 3% or lower of GDP when it's right now above 6%. And, so a lot of the studies and sort of techniques or plans would say, hey, let's get that done by in a decade, so by 2035. And then the other metric is that debt as a percent of GDP at 122% right now. You want to get that down to 60 to 80%. And that's going to be a little bit in terms of cutting spending, and it's going to be a little bit in terms of increasing or seeing good economic growth. All that to say, the word that is politically unappealing for sure is austerity. So whether that's cutting spending and maybe some entitlement reform, and or increasing taxes, but trying to do that without haircutting growth. And so that's the puzzle. And I would say that certain government leaders are focused on it. Others aren't, especially elected officials. So the area that's controlling the purse and the spending, is basically the federal government, it's Congress and the administration. They need to work together, and the bottom line is they haven't yet shifted to a focus on less spending and a little bit more austerity. So again, that's something we'll be talking about. We're actually going to write a special article for our Outlook report that'll come out in the early January timeframe, so more to come on that topic for sure. Now, turning to the markets, we've seen the short end of the interest rate curve, the Treasury curve, decline just a little bit as it relates to the anticipation over the coming year or so of further rate cuts. And, we've seen a little bit of volatility, but rates remain certainly well above the lows, let's say during the pandemic. The 10-year is at roughly 4.1%. It was roughly 0.5% during the lows of the pandemic. And so all that sort of then translates to continued appealing yields on bonds, different kinds of bonds. Now, when it comes to the bond market and Fed rate cut cycles, we did a little study just to look back at points when the Fed was cutting and sort of how the bond market did in the wake of that. And I think the punchline is most cases, once the cuts begin, the market tends to do better. In fact, a little bit in advance of the cuts. Recently, while we saw some positive returns on the U.S. aggregate, this is the U.S. bond market, taxable bond market, investment grade, basically there's a little bit of volatility, and I would say it's one of the lower returning paths when it comes to this cycle. But once again, generally speaking, the idea is when the Fed starts to cut, market rates follow. When rates fall, bond prices go up. And so we're kind of waiting for that that further decline in rates. And, honestly, one of the reasons it might not be happening quite as quickly is that fiscal trajectory issue, meaning people are a little worried about U.S. debt and they're wanting to get paid more for that level of increased risk as they see it. Now, another thing we took a look at to turn to the equity market is the idea that we wanted to understand sort of the makeup of the market and the dominance in the market. So we actually seen some work and sort of did a bit of our own to say, hey, let's look at the makeup of the top 10 U.S. companies by market cap in the U.S. market. And we happen to look at it as a percentage of the S&P 500. And if we go back, basically to 1985, so that's 30 years ago, essentially you're seeing companies like GE, General Motors, a bunch of oil companies, and AT&T. And, basically there's been such a transition when we look today. And by the way, back then it represented just over 20% of the overall market, that top 10 group. When we look today, essentially, aside from JP Morgan and Berkshire Hathaway, they're all essentially tech-oriented companies. And of course, the likes of Apple, Nvidia, Microsoft, Alphabet, meaning Google, Amazon, Meta, and then Tesla's in there too. And, when we look at it as a percentage of the S&P, it's not quite to 40%, but it's approaching. It's probably in the 37-38% range. And so, it's just a big change in the makeup of the dominant companies in the index. And that sort of coincides with what we've been seeing, right? The talk about the Magnificent Seven and the kinds of earnings and so forth. And so that these companies can provide. And so that obviously ties in some ways to some of these tailwinds we've been talking about, the idea of our long-term themes, how's the world changing around productive competition, consumption, demographics, the need to secure strategic resources, and how technology and innovation, especially around AI, sort of informing and supporting all of that. And so we've done a lot of work on AI. We've talked about that before when it comes to the impact on the job market, the impact on productivity, and in certain applications in the areas of things like sectors and industries like healthcare, cybersecurity, finance, that kind of thing. But a few data points that we found kind of interesting in this work. The first is that 45% of adults in the U.S. are basically using Gen AI in one form or another. A third of workers are using it at least once a week, and 10% of workers are using it every day. When it comes to impact, we see a survey saying that people think they're saving over 5% of time per week by using Gen AI when they're doing that. Companies are reporting that at least 10% of the companies are reporting that they've got mature implementations of AI. 80% are expecting AI to reshape their business over the next just 5 years. And then 41% are anticipating forecasters, let's say like the Fed, to increase their productivity kind of growth rate estimates because of artificial intelligence, which of course I think makes a lot of sense. All this is sort of a fuel to earnings. Earnings were better than expected recently, and so profit margins and earnings remain strong. And so it sort of begs the question, why are there some cracks in the market with all these positives going on? So, and just to give you a sense of the numbers, where you can see the S&P 500 since its recent peak, which was in the latter part of October, is down about 4%. But like the tech sector in the S&P, for example, over that same period is down almost 10%. And so, that we've seen a little bit of a pullback, not a lot, but a little bit. And it sort of begs the question, why? And basically, from our view, when we study sort of the average returns over 15 years, we study what happened last year and then what's going on this year, the concept of multiples and multiple expansion or contraction are playing a role. And so when we look back, for example, to 2024, and the markets were up a lot in the U.S., a good chunk of that was what's called multiple expansion, meaning that the price-earnings ratio is increasing. So prices are going up for whatever level of earnings, And that's sort of a sign of optimism about the future. And when we look at 2025, that expansion, that multiple expansion is still a positive component here in the U.S., but less so. And I'd say just generally, this modest pullback that we've seen basically relates to just people being a little bit more worried. And so that concept of PE, the premium that we've been seeing, we've been talking about them being the premium of the current PE to the 10-year average being about 25% round numbers over, it's down to 18%. So still a richly valued market, still a PE ratio higher than normal. But basically, we've seen the market give some of that back, a little bit around worries on labor and the shutdown and things like that, and what the Fed's going to do. And so, we've talked again a lot about that idea of a resilient market, but seeing a little bit of a pullback. We've talked about things that people could have and probably still should be considering, things like rebalancing. And if you're in a position where you want to take some risk off the table in your strategy, it has been still a good time to do that. And then, again, continued going forward, we're going to kind of keep an eye on things. Now, this month, I want to do something a little unusual and new, and that is to sort of shine a light on a publication that we create that's super popular. It's called Stifel Bits. And basically, this is an item. It's a little bit of a play on food, but the idea is we go out and find different bits of information we think are interesting. Sometimes there's a little bit of humor involved, and yet it often relates to some of our longer term work and our more serious work. So a couple examples. We in this month, I just want to highlight as an example the average daily rate for a U.S. luxury hotel. It's almost $400 to go stay at a nice hotel on average. Another interesting one, which switches over to AI, there was a survey done, I guess, by USC that was asking people to respond to human jokes versus ChatGPT jokes, and the AI jokes went out 70% to 30%. Now, the final one I'll mention is we focus a lot on the sort of the commercialization of space. So there's SpaceX that's sort of produced this new, I think, largest rocket called Starship, and they basically have done 11, if I'm reading this correctly, 11 test flights so far for that rocket called the Starship. So anyway, some interesting kind of fun little data points to sort of finish up. So just to wrap up, I'll just say, hey, we're mindful that markets have run pretty positively in 2025. It's against a backdrop where recession really isn't in focus, but there's potentially for a short period of time here a little bit of slowing that we could see in the economy, and so we have to be mindful that the markets have pulled back a little bit, may pull back a little bit more. But as long-term investors, we remain positive, and so just wanted to share some of those insights with you in this episode. Listen, we really appreciate you taking the time to be with us, and we'll catch you in December for our last episode of 2025. Thank you.
Thanks for listening to Stifel's Investment Strategy Brief. Be sure to subscribe wherever you're listening to automatically receive each month's podcast in your feed.